If you've been in the investing world for more than 5 minutes, you've probably heard of the Qs, that famous ticker symbol QQQ. It's one of the most traded, most successful ETFs in history. It's the home of big tech, the place you go to own the Apples, the Nvidias, and the Microsofts of the world. It's a powerhouse. But what if I told you there's a secret in the Invesco family? A younger, leaner, and cheaper version of that same exact fund that many long-term investors are now switching to. Its name is QQQM. Today, we're going to break down why that little M at the end of the ticker might just be the most important letter for your retirement account. This isn't just a minor detail. It's a strategic choice that could save you thousands of dollars over the long run. Stick around, because by the end of this video, you'll know exactly which of these two funds belongs in your portfolio. So let's start with the basics. What exactly is QQQM? The name stands for the Invesco Nasdaq 100 ETF. Just like its famous older brother, QQQ, it tracks the Nasdaq 100 index. This means when you buy one share of QQM, you are buying a slice of the 100 largest non-financial companies listed on the Nasdaq Stock Exchange. Think of it as a one-click way to invest in the titans of innovation. As of early 2026, when you look under the hood of QQQM, your top holdings are the heavy hitters of the AI revolution. We're talking about Nvidia, Apple, Microsoft, Amazon, and Meta. These are the companies that are not just shaping our present, but actively building our future. While the fund is heavily weighted toward information technology, making up over 50% of its holdings, it's a mistake to think it's purely a tech fund. It's so much more than that. You're also getting exposure to consumer giants like Costco, a company that has mastered logistics and customer loyalty. You're getting innovative beverage companies, and you're getting a piece of healthcare pioneers like Intuitive Surgical, the company behind the Da Vinci robotic-assisted surgery systems. Essentially, if a company is big, it's not a bank or a financial firm, and it's listed on the Nasdaq, there's a very good chance it's in this fund. It's a curated list of America's most dynamic and growth-oriented businesses. Now for the big question, the one you're probably asking yourself right now. If QQQ and QQQM hold the exact same stocks in the exact same proportions, why do two different funds even exist? This is where things get interesting and where you can really optimize your strategy. The answer boils down to two key things: cost and purpose. Let's talk about cost first. Every ETF charges an annual fee called an expense ratio. It's a small percentage of your investment that goes to the fund manager to cover their operating costs. The original QQQ charges an expense ratio of 0.20%. Meanwhile, its younger brother, QQQM, charges just 0.15%. Now, I know what you're thinking. 0.05%. Who cares? That's 5 basis points. It sounds like almost nothing. But in the world of long-term investing, where compounding is your best friend, every single penny counts. Let's run a quick example. Imagine you invest $10,000 and hold it for 30 years, with the market returning an average of 10% per year. With QQQ's 0.20% fee, your investment would grow to about $165,000. With QQQM's 0.15% fee, it would grow to about $169,000. That's a $4,000 difference. It's extra money that stays in your pocket, compounding for you, instead of going to the fund manager. Over a lifetime of investing, these small differences become enormous. So this brings up a logical follow-up question. Why would anyone on Earth still use QQQ if QQQM is cheaper? The answer lies in their intended purpose. QQQ was the first of its kind, launched way back in 1999. It was designed with high liquidity in mind. Liquidity means how easily you can buy or sell something without affecting its price. QQQ has massive trading volume, making it the preferred vehicle for institutional traders, hedge funds, and active traders who are moving in and out of positions quickly. It also has a much more active options market, making it the go-to for traders who use complex derivative strategies. QQQM, on the other hand, was launched much more recently, in 2020. It was specifically created for the retail investor. It's for the buy and hold crowd. It's for the person setting up a recurring contribution in their Roth IRA every single month and planning to not touch it for a decade or 2 or 3. Invesco basically created a Main Street version of their Wall Street product. They recognize that long-term investors don't need the extreme liquidity of QQQ, but they do benefit immensely from lower fees. So they gave us QQQMV, the same engine, but with a better long-term fuel economy. Now, let's zoom in on the growth story here, especially as we navigate the landscape of 2026. QQQM is positioned right at the heart of what many are calling the second wave of the AI boom. The first wave was about the hype, the initial explosion of interest, and the race to build the basic infrastructure like the chips from NVIDIA. We've now moved past that phase and into real-world adoption. The companies that dominate QQQM aren't just talking about AI or selling the shovels for the gold rush anymore. They are integrating artificial intelligence deep into the fabric of their businesses. Microsoft is embedding its Copilot into every piece of software. Amazon is using AI to revolutionize its logistics and cloud services. Meta is pioneering new forms of digital interaction. Healthcare companies in the index are using AI to discover new drugs and improve diagnostics. This is where theory becomes practice and where revenue starts to scale exponentially. One of the most brilliant features of an index fund like QQQM is that it's a market cap weighted index. That sounds technical, but the concept is simple and powerful. The fund automatically gives more weight to the winners. As a company grows bigger and more valuable, its position within the index naturally increases. If a new disruptive company emerges and climbs the ranks to become the next tech giant, QQQM will automatically buy more of it for you. Conversely, if one of the current giants starts to falter and lose market share, its weighting in the fund will decrease, and QQQM will slowly rotate out of it. You don't have to pick the winners yourself. The fund acts like a self-cleaning, growth-oriented machine, constantly rebalancing itself to bet on the future. Of course, we can have an honest conversation about the incredible growth potential of the Nasdaq 100 without also talking about the risks. High growth and high volatility often go hand in hand, and you need to go into this with your eyes wide open. The biggest risk is concentration. QQQM is top-heavy. As of 2026, the so-called Magnificent Seven stocks still drive a massive portion of the fund's returns. This means if big tech has a bad year, QQQM will have a very bad year. This isn't a theoretical risk. We have a recent example. Back in 2022, when interest rates were rising and tech stocks were getting hammered, the Nasdaq 100 index dropped over 30%. You have to have the emotional fortitude to watch your portfolio value drop that much and not panic sell. You have to be able to stomach that kind of volatility. The second risk is valuation. Many of these stocks trade at very high price-to-earnings multiples. In simple terms, you are paying a premium price for their expected future growth. If that growth doesn't materialize as quickly as the market expects, these stocks can be punished severely. You are betting on the future, and sometimes the future takes longer to arrive than we hope. Finally, remember the non-financial part of the index. There are no banks, no big insurance companies, and no diversified financial services firms in QQQM. This is a feature, not a bug, but it's something to be aware of. If we enter a period where the tech sector stalls but the financial sector booms, perhaps due to a specific interest rate environment, QQQM will lag behind a broader market index like the S&P 500, which has significant exposure to financials. This is why diversification across different types of funds is still so important. So, what's the final verdict? Is QQQM the right choice for you? Let's break it down simply. If you are a high-frequency trader who needs to move millions of dollars in seconds, or if you're a sophisticated investor who wants to trade complex options strategies, then you should probably stick with the original, the classic QQQ. Its massive liquidity and deep options market are designed specifically for you. But if you are a long-term investor, and I suspect that as most of you watching, if you are building a Roth IRA, a 401k, or a taxable brokerage account for your future, then QQQM is arguably the superior choice. It offers you the exact same performance from the exact same companies as the world's most famous growth index, but it does it for a lower price. It's a simple, elegant way to bet on human innovation and the relentless march of technology. It's a set-it-and-forget-it way to own the future. Just make sure you have the stomach for the ride, because while the destination with growth investing is often incredibly rewarding, the path to get there is almost always a roller coaster. You have to be willing to hold on through the dips to enjoy the climb. Thank you so much for watching. If you found this breakdown helpful, please hit that like button and consider subscribing for more content on smart investing. Let me know in the comments below, are you a QQQ or a QQQM investor? I'd love to hear your thoughts. See you in the next video.